Alright, you're welcome to the Forex Academy. This is Mama by the CEO of Zulu Academy. Alright, this is lesson three, and lesson three will be talking about market structure and different orders and MT4. Alright, by now I expected that you should have download your MT4 on your phones or your mobile phones on your personal PC, personal computer, or your desktop. And you should have opened a demo account by now. You should have linked your demo account to your MT4. I believe you must have done that by now. You should have customized your MT4 on your both devices, either your mobile phones or your PC. Alright. By now, I believe you should have done that. If you haven't done that, go back to lesson one and lesson two. Alright, and also you should have both the introduction to forex trade. Alright, so that will have given you a better guideline on how to go about all of these I've mentioned. Of course, by now you are opening an account with a broker, which is Ox Forest, which I recommend for all my students. So today we'll be talking about market structure and different orders on MT4. This is one of the most vital parts of the lessons that you need to take note of: market structure and different orders on MT4. What is market structure? I'll be sharing a few things about market structure. Market structure is one of the most important skills you need as a trader. The ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market condition. Of course, it is the market structure that helps you to know the strategy, to use, in knowing the direction of the market. What's the use of strategy? The use of strategy or tools or indicators or is for us to able to know the direction of the market. Either the market wants to buy or to sell. I told you that forex trading is all about buying and selling. The currency is buying the other currency is selling the other. The one is taking advantage over the other, the other is also taking advantage over the order. This is what we call the exchange that happens between them. The exchange that happens between this currency is what we call buying and selling. So now to know what the market wants to do, and I told you, I said the exchange that happens between these two pairs. I told you that the foreign exchange is all about an exchange or between two pairs. Between two pairs. Euro USD, for example, seems like Euro versus USD, something like GBP versus USD, AUD versus USD. Now this transaction is done by the bank institutionals. They are the one that actually run this transaction. All we have to do is to know the direction they want to follow, and we follow the direction. That's all. So we come with our strategies, in knowing this direction. And of course, what helps us to know the right strategy or the right indicator or the right tools to use is our market structure. It is very, very important. The first thing when you open your chart or when you open a pair the first thing you must be able to identify is the market structure. You are not going to treat all the market the same way. Yes. You trade the market based on the market structure of the pair. You need to study how the market move, how traders behave in the market. The market structure is the study of market behavior. And if you can master this skill, when you open your chart, you'll be able to answer these important questions. Yes, what the crowds are doing, who is in control of the market, buyers or sellers, what is the right time and place to enter or exit the market, and when you need to stay away. All of these questions, you should be able to answer this question before you place any trade. What are the crowds doing? Who is in control of the market? Is it the buyers or the sellers? What's the right time or place to enter or exit the market? And when you need to stay away. All of this is what the market structure helps you to identify. And through your price action analysis, you will experience there are three types of market structure. We have what we call the trending markets, we have what we call the ranging market, we have what we call the hobby market. All right. Now, under the trending market, we have two types of trending markets. We have the uptrending and the downtrending. All right. We have the uptrending market and the downtrending market. Another name for the uptrending is what we call the bullish markets. All right. Another name for the downtrending market is what we call the bearish market. And I told you that okay, that in the pair, all right, what we are talking about is the relationship between the bulls and the bear. I think I showed you that in okay, let me share my MT4. Right? So should have opened it before now. Very good. Okay. Like I said, all right, that what we are talking about is the relationship between the bears and the bull, all right? The bull are the candles going up, all right? The bears are the candle coming down, all right? The bulls are the candle going up, while the bears are the candle coming down. And I told you that the bull represents a buy, while the bear represents a sell. Now the bull represents a buy, while the bear is sell. Right? And I told you that okay, that in the pair we have what we call like Euro. This one is Euro versus USD. And I told you that the first one is always the base currency, right? The second one is the quoted currency. The Euro is the base, and the USD is the quote. For Euro EUD now, the Euro is the base, while the EUD is the what? Is the quote. There are three major pairs. All right, we call them major pairs. It is your Euro, three major currency pair: Euro, USD, and GBP. All right, these pairs are the major currency pair. All right, any pair with them is safe. All right, any pair with Euro is safe. Any pair with USD is safe. Any pair with GBP is safe. Though you need to be very careful with GBP. All right, when I'm going to teach, I'm going to talk about the market behavior. So you understand what I'm saying very well. You understand the behavior of those pairs. All right, how they behave in the market. All right, so that's by the way. There's a lesson ahead of this training that talks more about that. All right, so like I was saying, all right, I told you that it's about the relationship between the BS and the blue. All right, like and I was saying, I said we have three kind of market structure. All right, we have what we call the trending market, we have what we call the ranging market, and we have what we call the shopping market. Let me start with the trending market. The trending market, we have two types. We have the uptrending, also known as the bullish market. That is the market that is buying, all right, or a downtrending, also known as a bearish market, the market that is selling. All right. Let me show you something. Look at that. The market bought for a while, it will trace, but it will trace, but it will trace, but it will trace, but it will trace. Now, what are you seeing here? This is a trending market. All right. This is a trending market. So it went up, it came down, it went up, it come down. We call this place an impulsive movement. We call this place retracement, impulsive movement, retracement, impulsive move, retracement move, impulsive move. Now you will always find this in a trending market. What will you find? An impulsive move, an retracement, impulsive move, retracement. Now this is what we call a trending market. All right. What kind of trending market is this? This is an up trending market or a bullish market. All right, for a downtrending, it looks like this: an impulsive move, retracement, impulsive move, retracement, impulsive move, retracement, impulsive move, retracement, impulsive. All right, this is an example of what of a downtrending market or a bearish market. All right, you can see that this is an impulsive move, this is an retracement move, this is an impulsive move, this is an retracement move, an impulsive move, like that, like that, like that. So that is how it works, right? That's how it works in a changing market. And I hope that is clear. So now let me show you the real life chart. In the real life chart, let me show you how it works. All right, now what now to show you before I go to the real life chart is this. We call this place on higher, lower, higher, higher, lower, higher, lower. Like H, L. What is our higher, this was our higher, lower. While this one is our lower, higher, this one is our lower, higher, higher, lower. This is the LH, this is the LM, so that's how we define them to be, all right? Now, from this place to this place, we call it a swing, all right? At this point, there was a swing. Swing means that, okay, there was a little retracement, all right, that caused a swing here before we had time. But no one will talk about that in detail. Let's talk about a real life chart quickly. Okay? Look at this now. Now, how can you define this to be? All right, you can define this to be a trending market. You can see that bought, it trace, it bought, it trace, it bought, like that. But this one is not really a trending market actually. They trended for a while. And look at that. This is a good example of a trending market. You can see the market sold, it traced, it sold, it traced, it sold, it traced, sold, it traced, it sold. You can see that. And that's what we have to keep adding here. Alright, look at that. Still an uptrending market now. You can see it bought, it traced, bought. Now, let me come to forward now. Look at this one. These are top trending markets. And you can see that it's bought, it traced, bought, it traced, bought, it traced, bought. You can see that and keep moving like that. This is a trending market now. What kind of trending market is this? An up trending market. Look at this. Um, let me see it check. Look at this. And this is also an up trending market. Bought it to trace, bought it to trace, bought it to trace, bought. I do that and it's trending up like that, like that, like that, like that. So these are not trying to look at this. This is a downtrending market now. Sold to trace, sold to trace. This is a trending market. You can see that. So need to explain what we call an uptrending market and the downtrend. This is like higher, higher, just higher, lower, higher, 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 lower. Right, but for this we have our words lower, higher, lower, 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 higher, lower, 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 higher. So that's about that is clear about the trending market. So the first thing that we need to identify in the market is what we call the trend. Of course, as a day trader, when you start observing, I think that you use your our lesson two. We talk about time frames. I think we use our time frames to identify our market structure. As a day trader, we start observing your market structure from day one. Who is a day trader? Well, a day trader is the one that makes profit per day. A swing trader is the one that swing the trade. For example, you can do the trade up for more than a day, maybe two, three, four. Alright. We also have what we call the scalpers. The scalpers are, to me, I see them as gamblers. Alright, they can trade me multiple times on a particular pair, which I don't, I don't see it as a way to manage. I don't see that as I don't see it as a risk management actually. Alright, so these are scalpers, and we also have institutional traders. That's the bank, the big investors, and that like that. So these are the institutional traders. So as a big trader, every trader should start as a big trader. You observe the market from day one, or you can even start from week one, whichever way. This is not the time for that. Don't really come here too often. Only when I want to do, when I want to see the overview of the market. We have two views in the market. Number one, I will call the overview and the present view. We will call the market view and the present view. I'll talk about that. Don't worry. So as a big trader, you can start like this, start from day one. What do you see on day one? On Euro USD, we are seeing that the market is trending up, right? What you trace here, what you now currently is tracing, all right, that's on day one. On 4 hours, what are we seeing? I think that the market was trending up. When you got to this spot, something happened. All right, what happened? It started moving side by side. It bought for a while, sold, bought for a while, sold. This is not a trending market. This is a ranging market. Another name for ranging market is what we call is what we call the sideways markets, or when the market is moving sideways, all right? So that's another name for a ranging market. So presently now, at this present point, all right, the market is ranging. Even US is ranging on 4 hours, all right? And that's the present view, or the overview of the market view of is that the market is trending up. You can see that, which confirms with what we saw on day one. You can see that. All right. So 4 hours is telling you, okay, the general view or the market view that the market is trading up, but at the point, at this point, right, at this point, the market's entered a ranging point, right? A ranging point. I'm going to explain why the market range, all right? All right. I'm going to explain that when I'm talking about market behaviors, why we have a ranging market, why we have a ranging market. I'll talk about that in market behavior, all right? So, like I was saying, so presently the market was trending up at the point when it got to this price, all right, the market starts ranging, all right? And of course, presently the market is ranging. Okay, what about on 1 hour? What are we seeing? Oh, we are seeing a downtrending market. Wow. Can you see that? But the market is trending downward, all right? But the truth is this, higher time frame is the most accurate, all right? It gives us the big picture of the market. Now, if the one is showing us that the market is trending up, all right, I have a feeling that in the long run, all right, the market is going to buy, all right. Presently, where we only come to 1 hour to quickly make some profits, or we come to lower time frame to do our analysis and make some profits. All right, having in mind the structure we saw on higher time frame, which means that if I'm coming to 1 hour to sell this here, all right, I'll be conscious of the fact that on higher time frame the market is bullish, the market is uptrend. All right, so I won't. I'll be very careful the way I run my trade for a sell on lower time frame. Or not having in mind that the market is trending up. I'm getting that saying now, which means that if I relax myself selling this pair without being conscious of this market structure I saw in higher time frame, I might lose some money in this market. All right, so that's why I said that it's very important. All right, we go to higher time frame to see the big picture of the market, all right, then come to lower time frame, do your analysis, follow your indicators, all right, make some profit. Now, if this market, if I'm seeing, if I'm on lower time frame, I'm seeing a buy, I can confidentially buy this pair, all right, I can rest assured I'm safe. But if I'm selling this pair, I have to consciously sell this pair. Why? Because on the higher time frame, the market is bullish, the market is trending up. All right, so that means there's still possibility of a buy happening on this period. You know what I'm saying? All right, that's the one thing about market structure. All right, what about if 1 hour is also showing us an uptrending market? Definitely, we are seeing opportunities for a buy, which I feel we should do. All right, so that's about market structure. All right, so 4 hours confirms the day one, which means that on day one, we are seeing a bullish market. On 4 hours, it's saying that don't worry, we actually out of the bullish market, we are actually ranging. All right. Now, once we come out of this range market, of this ranging market, then we can decide which way to go. Either we want to continue bullish or want to start bearish properly. And once we come out of this pair now, then we can say that okay, maybe this kind of breakdown, or then you can say that we have entered another, or we have entered a bullish, also a bearish trend. Or if you break upward, then we have entered a bullish trend. But presently now the market is trending, which means that the market can buy at the point, sell to some point, buy at the point, sell to some point, and keep moving till we break out of this. Of course, that was something that's happened on day one. You can see that this is also confirmed that the market is ranging. You can see that we are only waiting to break out of this spot. Once we break out of this price, then we can know what we want to do. Right? But presently, we can still come to 1 hour down analysis, follow our indicators, and make some profits. Right? So, having in mind the structure that we are saying on higher time frame. Right? So, on 1 hour now, we are saying a downtrending market. Right? We know what to do. Don't worry, when we talk about our technical analysis, we will not be tools to use to trade in trending market. All right, so that's about that. So you need to identify what we call the trending market. Number two is what we call the ranging market, which I showed you just now. Ranging market also known as what a side by side. You can say that this market bought some price, sold, bought, and like that. Like I see that this is a ranging market. All right, look at this as well. I can also refer this as a ranging this sports. This is a ranging market. The market bought some point, sold, now it's buying. All right, it's possible you get to the point again and sell again and keep moving at that spot till there's a breakout. All right, let me look for another one that looks like that as well. Oh, very good. Look at this trend. You can follow. Oh, very. Look at this now. All right. Look at this. Very good. Look at this. This is a good example of a ranging market. All right. Market bought some points, sold, bought, sold, bought. And so that it's just moving at a particular spot. All right. This is the spot. The market is also moving at a particular spot. This is a very clear ranging market. All right. The ranging market is at a particular spot. All right. This is an example of it. And let me look for it. All right. This is also a good example of the ranging market actually. Let me see the particular. Okay, well, look at this. This is actually a good example of the market is ranging. All right. Though at the point it's trying to trend here, but it's still at a ranging spot. Alright. So I'm looking at see it's still in a particular spot or waiting for the breakout. Consider alright an example of the ranging in the market. Alright. So that's about what we call a ranging, also known as your sideways. This is an example of the ranging market too. Alright, so this is an example of the ranging market. Consider even on I think on this spot too. Really, I'm actually seeing a ranging market here. Okay? If I want to see the value of the market here. The overview here is the retail market. What we say the market view. Market bought, sold. I see that alright, but the present view is that the market is trending downward. Alright, that's the present view. But the really overview, the general view of this appears that the market is ranging. You can see that it went up a once, went down, it goes up, going down. You can see that 3 4 hours also confirming the same thing. So once we break out the thing, then we are sure of what the market wants to do. So there's how to trade a trending market. There's how to trade a ranging market, which I'm going to talk about in the next lesson. So what the last one is what we call a shabby market. The shabby market. Let me show you. The shabby market is also known as indecisive market. When the market is there to decide which way they want to go. Let me look for a very good example. Alright. So this I can refer this as the shopping market. Look at the spot. You can see that the market is just the candles are just looking as if they're insignificant. I don't know which way to go. And this is an example. Look at this as well. Let me take away this paper. And look at this. This is an example of it. This is a shopping market. When the market is here to decide which direction to go. This is a shopping market now. Such market you stay away. Alright, this is short. You can see this is a very good example of that. Look at this one. This is shopping market. This market here to decide which way to go. This is shopping market. Alright. These are nonsense. It's always look insignificant. Alright. And the time is it's also known as indecisive market. When the market is here to decide which direction to go, which way to go. Alright. This is shopping market. This is shopping market. Alright. This is shopping market. It's always insignificant. It's always but the even just quite confusing. That's a shopping. This is a shopping market. This is a shopping market. Consider this is a shopping market. Alright, so these are the three types of market structure that we have. So we have what we call the trending markets, ranging markets, and also have what we call the shopping market. So we will, if you want to identify the market structure, uh, that's the first thing you should identify in the pair. Once you open the pair, you should say, okay, this market is trending. Look at the overview, look at the market view, and look at the present view. Alright. Now you ask me on what view do you do your analysis in the present view? You understand that, alright? When I talk about multiple time frame analysis, I'll tell you how to do analysis both on the general view on the present view. But as a good trader now, just do your analysis on the present view. Because now, when I do my analysis now, I'll majorly stay with sorry, let me take a look. I'll usually stay with this, or I can do my analysis on this particular trend, or then I can make my decision on this, right? Because you know, we talk about multiple times, so you know how to do and combine both the analysis for the market view and the present view to make an accurate or a solid decision in the market. So that's about market structure. I hope that is clear. Let me show you some few of them on this material. See, yeah, you can see that it's a trading market, bought, sold, bought, trade. You can see that the kind of this of a down trading market. Okay, so this is a range, but this is a ranging market. Bought a wide, sold, bought. So you can see that it's a ranging market. And as well, this is a ranging market. You can see that bought a wide, sold, and keep moving on that particular spot. This is a ranging market. So bought. You can see that. This is a ranging market. Bought. You can see that. This is a short market, very, very indecisive. Alright, so that's very, very significant. So that's all about market structure. So if you want to ask me what's the best time frame to do your analysis and make decision, I would suggest 1 hour. Alright, I use 1 hour to make decision in the market. Alright, 1 hour for 4 hours. That is true. Majorly, I use 1 hour. Alright. Only when I want to make a very long time decision, I can 4 hours. But most times, I spend much of my time in 1 hour doing analysis, making a decision, making my profit in 1 hour or 4 hours. And I enter the market with 30 minutes. So that time is one my own trade. And I'll do the market from monthly time frame, weekly time frame, daily time frame. From the 4 hours to my analysis on 4 hours. Management, 1 hour, management during, I think management using 3 time frames. 1 hour, 4 hours during that I enter the market in 13 minutes. That's how I run. I take my profit in 1 hour. Uh, so that's about market structure. Now that's clear. Now let's talk about different orders in the market. All right, we have 5 different orders in the market. We have what we call the market structure. We have what we call the buy limit, the sell limit, the buy stop, the sell stop. Let me see if I can go very good. All right. So we have what we call the market execution. All right. Now the market execution. We have the buy limit, we have the sell limit, we have the buy stop, we have the sell stop. Alright, so now what is market execution? In Forex or in trading, we have 2 types of traders. We have the aggressive traders and the conservative traders. Who's an aggressive trader? An aggressive trader is the one that comes to the market in a rush. Or I mean, you see, whenever he sees a candle coming down, he assumes the market is selling and immediately sell or the peer or the market. Or probably it comes to the market and see that the candle is going up, immediately buy without doing any analysis. The kind of person there that this is that makes use of market execution. You can see that you just buy, sell, buy, sell, buy. Market execution is buying at the price of the market. Now let me explain what I mean. Look at the price of the market present. The price of the market is what is there. Consider it's changing now. But the market is one, that's why it's changing. That's it. Market price is changing. That's now as of now it's 1.174 can't. But the person now maybe he sees this candle coming down now and immediately sell. But the person makes use of what market execution, just click on sell or click on buy. So he's buying, he's selling at the price of the market. At this because it's also known as instant execution. Look at the price. He starts selling from this spot immediately. And if you also want to buy, you start buying at that same spot. It's the price of the market. That's market. And I'm not an aggressive trader, so I don't trade market execution. Or I trade pending orders. Under pending orders, we have buy limit, sell limit, buy stop, sell stop. That's what I trade. I don't trade market execution. I don't ask me why. I don't need to. I mean, if not, I don't ask me why. That's me. If I'm your coach and you're following me, I believe you do the same thing I'm doing. So I encourage you, stick with your buy limit, sell limit, buy stop, sell stop. Because by the time you are going to buy at the price of the markets, all right. Now the question is this: what about if you are going to sell this market at this particular price and the market choose not to go down and start going on? What happens? You start making losses. So which is that's the risk. It's one of the risks involved in trading market execution. So I'm a conservative trader and I trade in buy limit, sell limit, buy stop, sell stop. What is buy limit? I'm going to talk about it one by one. Let me start with buy limit and sell limit. All right. Wait, very good. Now let me try and put it down now so you can get it further. All right. Now look at that. The market started buying now. Retrace. Every market that is trend is expected to retrace. What is expect a retracement in trending market? It's definitely going to retrace. Even every market, the market is meant to retrace. Right? To retrace, it goes up again, it buys something, retrace. Now, I want to enter the market with a buy stop. All right, and I'm going to enter the market above this candle, maybe about 10 pips or 20 pips away. All right, then what happens when the market goes up? It takes me in for what? For a buy. So entering the market above the market price is what we call buy limit. All right, for a buy now. All right. Why if I want to enter the market at a retracement level? Maybe the market is buying. All right, I need to retrace, and I will take the market around this spot. But by the time the market retraces to this spot, to this price, it takes me in for what? For a buy. All right, I'm going to enter the market with a buy limit. Why? I'm entering the market below the market price. This is the market. Maybe this is where the market price is. Market is still coming down. All right. I'm already placed my order around this spot. And by the time the market moves to that spot, it takes me in for what? For a buy. This is what we call buy limit. All right. Why if I'm waiting the market above the market price, I'm going to use buy stop. All right. I hope that is clear. All right. For a sell limit and sell stop, very the same way. The market sold, it retraced, it sold. Now, so let me clear this nonsense. Okay, the market sold, it retraced, sold. Now I waited for the market around this spot, around this price. All right, by the time the market enter for a sale and touch this price, it takes me for what? For a sale. So I'm going to enter the market to what? It sell stop. But I'm entering the market above the market price. But if the market is selling and it's retracing, it's sold and it's retracing, now we wait for market at the retracement level. Now by the time the market that is below the market price, but when the market retraces to this price, it takes me in for what? For a sell, right? So I'm going to enter the market with what? The sell limits. I enter that sell stop above the market price, sell limit below the market price. Let me show you on the real life chart. So understand what I'm saying better. Right now, look at this now. The market is presently buying, presently, right? Now, we look at what happened. The market traced at this spot. What about if I've entered the market for a buy with sold from a buy? I will have entered with what? At this spot, look at the price. I will have entered with 0.91476. I will enter with what? With a buy limit at the spot. Right. But now the market is done with tracing, is moving up. I can't enter with the buy limit again. I'll enter with what? With the buy stop. I wait for the market above the market price. This is market price. I wait for the market above the market price. That's 0.91597. I'm going to use a what? A buy stop. All right. But if I'm entering the market at the retracement level, so I'm thinking that the market is still going to retrace. I can wait for it here. What happens? By the time it retraces. Now, how do I know the market will retrace to that spot? Look at where this candle. When the market brought to this point, it retraced at this spot, right? Like you can see a red candle now. That's a retracement point. Retracement move. The market bought again, it retraced again. I expect the market to retrace to the same spot where it retraced at this spot. Look at it. Either to this spot or to this spot. Why? Why am I saying to this spot? Because even this same spot, you can see that it retraced to this spot. You can see that, right? So either this market, now I'm going to wait for the market with a buy limit now. I can either use this where it retraced initially or with this place where it retraced here. So I can wait for the market. And you can see that at that same spot, this retracement got to this same spot where this one. Let me see. This same spot where this one stopped. This one retrace same with this spot where this one also was retraced. You can see that the same spot. So I can enter with a what? With a buy limit at the same spot. Consider this where this one retraced. That's same with this one also retraced. So I'm going to use a what? A buy limit to enter. But you can wait for the market above the market price. If that's around the spot, then I'm going to use a what? A buy stop. And I hope that is clear. Let me use sell. Now this market is selling presently, but this spot what happened? It retraced. You can say that. All right. Now I can wait for the market around this spot. What will I use? I will use a what? A sell limit. So I'm waiting for the market below the market price. All right, the retracement level. So when my market retrace to that spot, what happens? It takes me in for a sell. You can see that. But now the market looking as if it's want to say, I'm seeing a red candle now. All right, signifying the sell. That's the color I use to represent my bear. All right. So what happens? I can wait for the market to be above it. You can see that that's around the spot. So what happens is that I'm going to use a what? A sell stop. Now this is the beauty of it. By the time the market does not get to this price before, all right, does not get to this price, all right, and start moving up. You know why? I don't make losses. Why? The market has not touched my entry point. So I'm still safe. So until this market touches entry point, the market will not trigger. What happens? Even though it doesn't, maybe I place my entry here, that's 1.17402. But the market choose not to sell, the market wants to buy, it start moving up. What happens? I don't make any loss. All I have to do is just close my order. That's all. But the market is moving against my prediction. Then I just close my order. Simple. I don't without any single loss. Right. So that's the beauty of your buy limit, your sell limit, your buy stop, and your sell stop. And I hope that is all about. I hope you understand what I mean by buy different orders in the market. I hope that's clear. All right. So I've successfully been to explain to you what we call the market structure and different orders. Under market structure, I told you that we have the trending markets, the ranging markets, and the short market. I told you that you start up as a day trader, you start observing the market from day one or week one, all right, down to 1 hour. Do your analysis on 1 hour, you take your decision on 1 hour, make your profit that 1 hour, 4 hours, then you're out of the market as a day trader. But if you want to swing a trade, then you can now come to monthly time frame to do your analysis. Sydney market, and I told that they have two kind of view. We have what we call the market view, and the market overview, and also what we call the present view. All right. When time you come to the market every day, you do your analysis on the present view, all right, and run your trade, having in mind of the market view. All right. Very, very right. So there's one thing the market respects so much, right? Your market structure. Please, if the market is trending up, it shows that the market has opportunities for a buy. If the market is trending down, it shows that the market has opportunity for what? For a sell. That's it. So when the market is trending up, look for a buy. When the market is trending down, look for a sell. Right? But though before you make your decision, you should have done get confirmations from the use of tools and indicators. That's what we call technical analysis. And I've showed you how to run your trade. You run your trade with orders on MT4. Right? Either you run your trade with market execution, you run your trade with buy limit, you run your trade with buy stop, you run your trade with sell limit or sell stop, depending on what you are seeing in the market. And I told you I don't run my trade with market execution. All right, I run my trade with that with the buy limit or the sell limit, a buy stop, a sell stop, and explain what to call buy stop. Buy stop means buying the market above the market price. Say buy limit means buy the market below the market price. All right, at the market below the market price. What is sell stop? Selling the market above the market price. What is selling? Selling the market below the market price. And I hope I'm able to explain that. So your assignment now is this: you're going to open several pairs. All right, then you want to identify the market structure on both on 1 hour and on 4 hours. That's your assignment now. You're going to send it to your coach. Let him analyze and evaluate your assignment. Let him see if there's any need for any adjustment in any area. All right, and I hope that's clear. All right, so I told you time frames is what you use to view the market structure. All right, so if you have any questions, you can always send it to the group, to the general group, or you forward it to your coach after this lesson. So thank you. You have a great thing. So you can move down to lesson 4, where we talk about technical analysis. Technical analysis 1. All right, that's lesson 4. So I'll get prepared for lesson 4 and move down. Thank you.